Today, we're going to dive into a really powerful technique, one that helps successful traders see what almost everyone else misses. We're talking about multi-time frame trading.
So let me ask you something. Do you ever feel like you're just reacting to every little price flicker, you jump into a trade, and then bam, the market immediately turns against you? If that sounds even a little bit familiar, you're probably missing the big picture.
And this analogy just hits the nail on the head. Relying on a single time frame, a single chart, it's like trying to drive down the highway while staring at nothing but the hood of your car. Sure, you'll see all the little bumps right in front of you, but you have absolutely no idea where the road is actually going.
This is exactly what leads to what we call trading with tunnel vision. When you're hyper-focused on just one chart, you end up reacting to all the market noise, not the real trend. This is how so many traders get caught in those super frustrating whipsaw effects. When the market shoots one way, stops you out, and then immediately reverses and goes right where you thought it would. So painful.
So, how do we fix this? How do we stop staring at the hood? Well, the solution is to get a 30,000-foot view of the market. And we do this with a technique called Multi Timeframe Analysis, or MTFA. And trust me, it is the key to trading with real context and clarity. So, what is MTFA? Exactly. It's actually pretty simple. It just means looking at the same asset, whether it's a stock, a currency, whatever, across several different time frames, all at once. This gives you this complete layered view of what's happening, letting you see the big picture story and all the tiny details you need to make your move. And the advantages here are just huge. First off, you get incredible trend confirmation. Think about the confidence you'd feel in a trade if the weekly chart, the daily chart, and the hourly chart are all pointing in the same direction. Second, you can pinpoint your entry and exit points with, surgical precision. And finally, you get much better risk management because you can set smarter stop losses that are based on the real market structure, not just some random noise.
Okay, so let's think about these different time frames. Like you have different lenses for a camera. Each one has a very specific job, and when you use them together, they give you a crystal clear picture of what the market is doing.
Your first lens is your wide-angle lens, the long-term frame. This is your weekly or maybe even your monthly chart. It's for seeing the forest, the big, dominant primary trend. This tells you the overall direction of the journey. Are we generally climbing a mountain or heading down into a valley?
Next up, we switch to our standard lens, the medium-term frame. This is usually your daily chart. Now you can't see the whole forest anymore, but you can clearly see the trees. These are the intermediate swings and pullbacks that actually make up that larger journey. And finally, we have our zoom lens, the short-term frame. This could be an hourly chart or even a 15-minute chart. This is where we get to see the leaves. It's all about those fine details, helping us pinpoint the exact, most optimal moment to get in or get out of a trade.
So here's how it all breaks down. That long-term frame, its purpose is to identify the primary trend. That's your strategic view. Then the medium-term frame, that's for tracking the intermediate swings and finding trading opportunities, perfect for swing traders. And then you have the short-term frame, which is all about fine-tuning your execution. That's the playground for day traders and scalpers. See how each one builds on the other?
Okay, so the theory is great, but how do we actually do this? Let's make it practical. Here is a simple 3-step playbook that you can use to apply this technique right away.
It's a top-down approach, which is really important. Step 1, you always start with your long-term chart to find that primary trend. The goal is to trade with it, not against it. Step 2, then you move to your medium-term chart to find a good spot within that trend, like a pullback. And step 3, then, and only then, you switch to your short-term chart to find the perfect, low-risk entry point to pull the trigger. And right here, this is the golden rule. If you remember one thing from all of this, make it this. You need alignment. A bullish signal on your short-term chart is like 1,000 times more powerful if your medium and long-term charts are also bullish. Waiting for this synchronization is what separates a high-probability trade from just a random guess.
And what's really cool is that this framework is totally flexible. It's not one-size-fits-all. A swing trader, for instance, might use the daily, the 4-hour, and the 1-hour chart as their 3 frames. But a scalper, who's in and out of trades super fast, might use the 1-hour, the 15-minute, and maybe even the 5-minute chart. The principle is exactly the same. You just adjust the scale to fit your personal style. Now, putting this into practice isn't always perfectly straightforward. So to help you get it right, let's go over the 3 most common pitfalls, the mistakes that trip up traders when they first start using this method.
Okay, warning number 1, and this is the big one.
ignoring the main trend. Seriously, if the weekly chart is in a screaming downtrend, trying to buy a little balance on a 15-minute chart is like trying to swim up a waterfall. It is a low probability, high-risk trade that it rarely ends well. Don't fight the current.
Mistake number 2, acting on a signal without confirmation. So, you see a promising setup on your medium-term chart, that's great, but it's not enough. You have to wait for the short-term chart to agree to give you that clear entry signal. Acting on just one frame alone isn't analysis, it's just gambling.
And finally, warning number 3, overtrading. In choppy, volatile markets, the short-term charts can look chaotic, right? They're throwing off dozens of potential signals. But without the context from the longer timeframes to ground you, you're just going to get chopped up by all that noise. The key is to be patient, be selective, and wait for all 3 of your frames to line up.
So let's just bring it all home. Multi-timeframe analysis gives you a complete map of the market. It's the difference between just reacting to noise and actually trading in harmony with the primary trend. You stop fighting the market and you start flowing with it. Ultimately, this whole approach transforms your trading from a one-dimensional guess into a 3-dimensional strategy. You finally get to see the forest, the trees, and the leaves, all at the same time. So the only question left is, now that you can see the whole map, where will your next trade take you?